Welcome to Validea University. In this series of short videos, we will discuss some key investing concepts that impact investors today and distill them down into their most important components. In today's video, we discuss the quality factor. There is probably no investing factor that makes more sense to your average investor than quality. It seems intuitive that building a portfolio of high-quality companies should lead to great investment returns over time. But like most things in investing that seem obvious, it isn't always that simple. There are many nuances to using quality in an investment portfolio that are important to understand. At a high level, quality is about investing in companies with good, profitable, consistent businesses. But how you identify those types of companies varies widely among investors. Here's a description of the many factors that go into defining quality from quant firm AQR Capital Management. AQR Capital Management has defined the factor QMJ, or quality minus junk, to be companies with the following traits: low earnings volatility, high margins, high asset turnover, low financial leverage, low operating leverage, and low stock-specific risk. This definition shows just how many different ways an investor can view quality. It can be looked at as investing in firms with high margins or high returns on capital. It can also involve investing in firms with consistent sales and earnings over time. It can also be defined using balance sheet-related criteria like low debt or high asset turnover. On the surface, it is easy to think that buying high-quality businesses should produce an excess return. And the academic research shows that quality does in fact do exactly that. But the reason it does that may be different than what you think. If you believe that the market is efficient, then most stocks should be fairly priced relative to the information that is publicly available. Great businesses typically trade at premiums to bad ones. In an efficient market, buying high-quality companies wouldn't produce an excess return because you would have to pay more to acquire them. Investing factors that work over time typically do so for one of two reasons. Either they are riskier than the market and investors get paid for taking on that risk, or they capitalize on some sort of systematic mispricing due to investor behavior. It is hard to argue that buying high-quality companies is riskier, and most practitioners don't believe there is a risk-based argument for quality. It is also hard to argue that investors would systematically underprice high-quality companies. But most researchers do believe that the mispricing argument is what best explains why quality works. Some argue that investors tend to focus too much on the short term and thus overprice companies doing well over short periods of time relative to high-quality companies that deliver more consistent long-term results. Others argue that investors overstate their own skill and try to find diamonds in the rough, which leads them to overprice those types of securities relative to high-quality firms. Rather than using it as a standalone factor, the best use of quality may be in conjunction with other factors. For example, combining quality with value can help to eliminate stocks from a value screen with significant problems in their underlying businesses. Some firms prefer to use quality as a negative screen where they eliminate the lowest quality companies, while others prefer to look for positive quality attributes. But either way, quality can be a significant enhancement to a value strategy. Certain value metrics like price to earnings or price to cash flow have quality embedded in them, so they can add quality to a value portfolio even if quality isn't used directly. In the end, quality remains somewhat of an enigma. It can be difficult to define, and every firm that uses it seems to have their own unique take on what works best. And it clearly works over time, but the reason it does so is tough to pin down, which makes some question whether it will work going forward. In the end, its best use may be as a supplement to the other major investing factors, where it can help to boost risk-adjusted returns. Quality may not have the evidence to support it that value and momentum do, but when used properly, it can be an enhancement to many portfolio strategies. This concludes our look at the quality factor. We appreciate you taking the time to watch the video. To find more of our Validea University videos, you can follow our Validea channel on YouTube. You can also follow us on Twitter at @GuruInvestor. To read our investment commentary, you can go to our blog at blog.validea.com. To take a free trial to our subscription product, which includes the 22+ factor models we run, you can go to our research website at www.validea.com. Thank you for watching.